Alright, today I'm going to be going over the ICT concept of SMT, also known as SMT divergence. Before we get into it, you just have to really know that the concept of the SMT is used tons in trading, and you need to understand it very well to perform at a high level in the markets. So without further ado, let's get straight into it. To understand SMT, you must first understand what correlated assets are. So pretty much correlated assets is two assets that move in sync but not completely the same. So say we have one asset right here that moves like this, but we have the other asset that is correlated with it that moves like this, and it takes out this high, right? So the left asset leaves this high and the right asset takes out the high. This forms an SMT divergence. See, the reason this is so important is because both NQ and ES are correlated assets, so they move very similarly in the markets. Now, let's just take the current high time frame for example. On the left we have ES and on the right we have NQ. On the left, for ES, we move down, filling in this new week opening gap, and then we move higher. Same exact thing on NQ, we move down, fill in this new week opening gap, and move higher. And if you look at the draws higher, we have relatively similar buy side above, right? So this is why these indexes are correlated. They don't move perfectly the exact same, but like relatively they move the same. Now, this is where the concept of an SMT comes in. Now, what an SMT is a divergence between the indexes. So that means one index takes a certain price point in liquidity, like a certain liquidity point in price, and the other does not. This signals institutional movement and it signals a possible reversal. Now, for an example, say we have ES move up, it displaces down here, and then it moves up again, taking out this London high, right? So this is going to be our London high. And the same thing happens on Q. We move up, retrace, and we do not take out the London high. What is this? This is a SMT divergence. This is exactly what it looks like in the markets, and you mark it out. You grab this tool to the left, and you use this line like this, mark it at the top wick to the top wick of this manipulation leg, SMT. Now, some quick rules of thumb for the SMT is that it should never be used by itself. So if you just see an SMT in the market and you see a market structure shift in the opposite direction, it's invalid because it's not a strong enough confluence to hold your trade. And an SMT should always be paired with other confluences. So this could be delivery off a high time frame key level. This could be with your daily bias. Now, essentially what an SMT is useful for in your trading is it adds extra confluence to your trade, overall adding probability, and it helps you find your market narrative and daily bias. An example of an SMT helping you build your daily bias could be from this day right here. You can see here that on ES, we have this 10 a.m. 4-hour swing candle still intact. It has not been swept out yet. Opposed to that, on NQ, NQ has swept it out, forming an SMT divergence. So this is a bearish SMT divergence, and from here, what you could expect is you could expect price to come down, rebounds this range, to then move higher. And if I play it out, that's exactly what happens. Now, an example of an SMT being used to add extra confluence to your trade could be just this Friday, where NQ comes up, sweeping out this swing high, this AM high, and if we look at ES, ES does not come up and sweep out this swing high, therefore creating a bearish SMT. Although it is very important to note, at the same time this SMT is formed, ES sweeps out this 15-minute intermediate high. So we have true manipulation, and the SMT is only valid and only can be used in trading if we have manipulation on both indexes. From here, you get the confirmation that price is respecting this SMT after seeing price print a wick outside the range and close a body back inside the range, overall giving us this 1-minute IFEG. And from there, you just enter in the short, take profit hit extremely fast, using this SMT as an extra confluence to add probability towards your trade. Now, the key takeaways of this video are that both ES and NQ are correlated assets. This means that when one asset takes a swing high and the other does not, this forms a SMT. An SMT is only to be used when delivering out of a high time frame key level, because when it's not paired with your daily bias or manipulation, then it does not matter, it's going to fail.